David bought gold. Ryan bought a rental property. They both tell their friends they made the smarter investment. David says gold has protected wealth for thousands of years. Ryan says real estate creates millionaires. They're both convinced the other guy is missing something obvious. They're both wrong. Because the biggest difference between these two investments isn't what most people argue about. It isn't inflation, it isn't appreciation, it isn't even leverage. It's a handful of numbers that almost nobody bothers to calculate, and by the time those numbers show up, the gap between these two investors has quietly become massive. Today we're going to run the full math, not opinions, not social media advice, just numbers. To keep this fair, David and Ryan start with exactly the same situation. They're both 32 years old. They both live in Dallas, Texas. They both earn $95,000 a year. They each have $120,000 saved. Neither receives an inheritance. Neither has investment experience. Neither gets lucky. One decides to place his $120,000 into physical gold through a combination of bullion and low-cost gold ETFs. The other uses the same $120,000 as a 20% down payment on a $600,000 rental property. Same age, same city, same income, same starting money. Only one decision changes. Now, let's see what actually happens. Ryan buys the property. The purchase price is $600,000. His down payment is $120,000. He finances the remaining $480,000 with a 30-year fixed mortgage at 5%. His monthly principal and interest payment comes to roughly $3,035. Property taxes in his area add another $700 per month. Insurance averages about $180 monthly. Maintenance is budgeted at 1% of the home's value each year, or roughly $6,000 annually. He also expects about 5% vacancy over time. David keeps things much simpler. He places his entire $120,000 into gold. Half goes into insured physical bullion. Half goes into a low-cost gold ETF with an expense ratio below zero. 20%. Storage and insurance for the physical gold average about $600 per year. The ETF charges roughly $120 annually on its portion. No tenants, no mortgage, no contractors, no late-night phone calls. Immediately their emotions move in opposite directions. Ryan gets the keys. Friends congratulate him. He posts photos. People call him an investor. David gets a statement, a vault receipt, maybe an ETF confirmation email. Nothing exciting. No one congratulates someone for owning metal sitting quietly in storage. One investment feels real, the other feels invisible. But feelings and math are two very different things. Let's fast forward 1 year. Gold has appreciated by approximately 9%. David's $120,000 is now worth about $130,800. After approximately $720 in annual storage and ETF expenses, his investment sits around $130,080, a gain of just over $10,000. Simple. Ryan's story looks much bigger. His property has appreciated around 4%. The home is now worth approximately $624,000. That's a $24,000 increase, already more than double David's gain. Sounds incredible. Until we subtract everything else. Property taxes for the year totaled about $8,400. Insurance cost another $2,160. Maintenance consumed roughly $6,000. Vacancy reduced rental income by approximately $2,000. Closing costs from the purchase were nearly $12,000 before he ever collected his first rent check. Meanwhile, much of his mortgage payment during year 1 went toward interest instead of principal. After everything, Ryan's equity has grown, but nowhere near the flashy appreciation number people love quoting. On paper, the property gained $24,000. Sounds great until you subtract everything else. Already the story feels different. By year 3, another surprise appears. Gold experiences 1 weaker year and 2 stronger years. Its average annual return over the period lands near 8%. David's portfolio reaches approximately $151,000 before costs. After annual storage and ETF expenses, he's sitting around $148,500. Ryan's property has continued appreciating at roughly 4% annually. Its market value is now close to $675,000. That sounds fantastic, except maintenance isn't staying flat. An HVAC repair costs $7,800. A water heater replacement costs another $2,100. A tenant moves out unexpectedly. 2 months of vacancy eliminate thousands in rental income. Then comes repainting, professional cleaning, advertising, screening new tenants. Another $3,500 disappears. None of those costs increase Zillow's estimated value. Nobody brags about replacing an air conditioner. They only mention appreciation. By now, Ryan's mortgage balance has declined only modestly because early mortgage payments remain heavily weighted toward interest. His total equity has improved thanks to appreciation, but the cash leaving his bank account has also been substantial. David, meanwhile, hasn't received emergency phone calls. He hasn't negotiated contractor quotes. He hasn't replaced appliances. His biggest annual decision has been renewing insured storage. Different lifestyles, different headaches, different math. Now let's jump to year 5. This is where most online comparisons become misleading, because year 5 is usually when people compare only asset values. Ryan says his property is now worth roughly $730,000. David says his gold holdings have reached approximately $176,000 after costs. At first glance, Ryan appears to be crushing the comparison. His property increased by roughly $130,000. Gold increased by about $56,000. Case closed. Except, that's not actually the comparison. The comparison isn't asset value. It's investor wealth. Those aren't always the same thing. Ryan still carries a substantial mortgage. Selling the property would require agent commissions that often range from 5% to 6%. On a $730,000 sale, that's roughly $40,000. Closing expenses remove several thousand more. Capital improvements over 5 years have already totaled more than $20,000. Property taxes alone have exceeded $45,000 across 5 years. Insurance has crossed $11,000. Routine maintenance has added another $30,000. Some expenses were partially offset by rental income. Some were deductible. Some increased rents over time. But every one of them affected real cash flow. David also paid costs. 5 years of storage and ETF expenses total roughly $3,600. That's it. No roof, no plumbing, no eviction risk, no surprise foundation inspection. By the end of year 5, both investors have made money, but neither has made nearly as much as people assume after hearing only one headline number. And that's exactly where most investment conversations stop. The really interesting part begins after this point, because from here onward, one small difference starts compounding much faster than almost anyone expects. From year 5 onward, the comparison starts changing in a way that surprises almost everyone. Ryan's property keeps appreciating at roughly 4% per year. By year 10, it's worth about $888,000. That headline sounds incredible. An increase of nearly $288,000 over the original purchase price. On paper, that's a huge win. Sounds great until you subtract everything else. During those 10 years, property taxes have climbed with home values, averaging roughly $9,500 to $11,000 annually. Insurance premiums have increased too, reaching about $3,200 per year. Maintenance hasn't slowed down. Roofs don't last forever. Neither do furnaces, fences, driveways, or exterior paint. A common rule among experienced landlords is to budget between 1% and 2% of a property's value every year for repairs and capital expenditures. On Ryan's property, that averages roughly $7,000 to $10,000 annually. Then there's vacancy. Even an excellent property manager can't eliminate turnover. A month without rent every few years quietly removes thousands from long-term returns. If Ryan hires professional management, that's another 8% to 10% of collected rent. If he manages the property himself, he saves the fee, but spends evenings, weekends, and vacations answering tenant calls. Time has value too. Meanwhile, David's gold investment has quietly continued compounding. Assuming an average long-term annual return around 8%, his original $120,000 has grown to approximately $259,000 before expenses. After storage and ETF fees, he's sitting near $252,000. No leverage, no tenants, no debt, no monthly obligations. That's the first flip point. For years, Ryan looked dramatically ahead because everyone focused on the home's market value. But once you compare actual investor wealth instead of headline appreciation, the gap becomes much smaller than most people expect. Now let's fast forward another decade. Year 20. Ryan's property is now worth approximately $131 million if appreciation averaged 4% annually. That sounds like an extraordinary investment. And in many ways, it is. But let's finish the math. His mortgage balance has fallen substantially after 20 years. He's built meaningful equity through both appreciation and principal repayment. If he sells, however, transaction costs still matter. A 5% real estate commission on a $31 million sale approaches $65,000. Closing costs can easily add another $10,000. Deferred maintenance before listing might require another $20,000. Along the way, 20 years of property taxes have likely exceeded $220,000. Insurance may have totaled another $70,000. Maintenance and capital expenditures can easily exceed $180,000 over 2 decades, especially once roofs, HVAC systems, appliances, flooring, plumbing, and exterior work are included. Those numbers aren't unusual. They're simply the costs of owning real estate for a long time. Now compare David. At the same 8% annual return, his investment reaches approximately $559,000 before costs. After 2 decades of storage and ETF expenses, he finishes around $540,000. No commissions unless he decides to sell. No mortgage. No property taxes. No repair bills. No leverage either. And that's the key. Ryan finishes with a larger net worth because leverage amplified his gains as property values increased. But he also accepted dramatically higher risk, significantly larger cash commitments, and years of ongoing responsibilities. David earned less in absolute dollars. He also slept through every broken water heater. That's why comparing only returns misses the point. The real comparison includes effort, risk, debt, liquidity, and stress. Now let's talk about what almost nobody mentions. Everyone loves talking about appreciation. Very few people talk about carrying costs. The first hidden number is maintenance. People budget for mowing the lawn. They forget roofs. A single roof replacement can easily cost between $12,000 and $25,000 depending on the property. The second hidden number is capital expenditures. Appliances eventually fail. Air conditioners stop working. Water heaters leak. These aren't monthly expenses. They're irregular, which makes them easier to ignore until they happen.
The third hidden number is vacancy.
One empty month each year reduces annual rental income by roughly 8%. Even one vacancy every 3 years quietly changes long-term returns. The fourth hidden number is transaction costs. Buying and selling real estate isn't free. Agent commissions, title fees, inspections, transfer taxes, and legal costs can consume tens of thousands of dollars. Gold has costs too. Physical bullion requires secure storage and insurance. Gold ETFs charge annual expense ratios, although many remain below 0. 20%, they're much smaller costs. But they still exist. The fifth hidden number is opportunity cost. Ryan tied himself to a highly leveraged property. Accessing that equity usually requires refinancing, borrowing, or selling. David's ETF shares can generally be sold during market hours in seconds. Liquidity has value, especially during emergencies. If I only showed you the downsides of real estate, I'd be doing exactly what every gold influencer does. Real estate has enormous advantages. Leverage allows you to control a large asset with relatively little cash. Rental income can offset ownership costs. Certain expenses may be deductible. Long-term owners may benefit from depreciation and, in investment properties, strategies like a 1031 exchange that allows taxes on qualifying gains to be deferred when reinvesting into another qualifying property. Gold can't generate rent. It doesn't produce cash flow. It simply sits there. Gold can also experience long periods with disappointing returns. There have been stretches lasting many years where inflation-adjusted returns were minimal. If you need regular income, gold won't provide it. Real estate might. So when does real estate clearly win? First, when rental income comfortably exceeds ownership costs while vacancy remains low. Second, when investors use conservative leverage instead of borrowing beyond their means. Third, when appreciation stays strong over decades. Fourth, when owners actively improve properties, increasing both rent and market value. And when does gold win? During periods of unusually high inflation. During financial crises when investors seek perceived safe haven assets. For people who prioritize liquidity, or for investors who simply don't want another part-time job managing property. Notice something? Neither investment wins all the time. Context wins. Now let's ground this discussion in real data. According to the Federal Reserve's long-run analysis of U.S. residential housing, home prices have historically appreciated at roughly 4% annually over long periods, although local markets vary significantly. According to the World Gold Council, gold has delivered approximately 8% annualized returns in U.S. dollar terms over the past 2 decades, though returns differ depending on the exact measurement period. The Internal Revenue Service also allows depreciation deductions on qualifying rental properties, while taxing investment gains according to applicable capital gains rules. Those aren't opinions, they're simply published facts. So what's the practical strategy? First, calculate every ownership cost before comparing appreciation. Include taxes, insurance, maintenance, vacancy, selling costs, everything. Second, estimate realistic, not optimistic returns. Don't assume your neighborhood will outperform forever. Don't assume gold will repeat its best decade. Third, decide what you're optimizing for.
Maximum net worth?
Monthly cash flow, liquidity, low stress. Those are different goals requiring different investments. And here's one lever that changes everything. If David invested an additional $200 every month into gold alongside his original investment, assuming the same long-term return, he'd finish with well over $650,000 instead of roughly $540,000. If Ryan used an extra $200 monthly to accelerate principal payments or fund additional investments, his outcome would improve too. Small monthly decisions become enormous over 20 years. Let's go back to where we started. David bought gold, Ryan bought real estate. They both walked away believing they had made the smart play. David believed stability would outperform everything else. Ryan believed leverage guaranteed wealth. Neither one actually ran the full numbers, because the real trap isn't gold, and it isn't real estate. The real trap is making the decision based on hype, headlines, or someone else's opinion instead of running the numbers for your own situation. The best investment isn't the one that looks impressive at a dinner party. It's the one that matches your goals, your risk tolerance, your cash flow, and your ability to stick with it for decades. And if you're wondering what happens when someone combines both strategies, using real estate for income while holding gold as a long-term hedge, that's a completely different conversation. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.